Well, prices moving higher this morning, back above 81.40. They must have rebounded a little bit yesterday as well from early morning weakness. Tightness in the market may be about to ease, though, according to the new International Energy Agency monthly report that was out overnight. The group says it expects output to rise by 1.5 million barrels a day for the remainder of the year. Joining us now is Jeff Currie, Global Head of Commodities Research at Goldman Sachs. Hey, Jeff, it's good to see you. How long you been with Goldman?
25 years, doing the exact same thing.
Do you remember the super spike forecast of 300 from a couple of, how long ago? I'm so old. Was that 10 years ago?
That was like 07, 08. And no, we never forecasted $200 oil. We were at 150.
There were worries of a super spike, though, and I mean, is it about time to start thinking about that again, or is this sort of another sort of a head fake that will probably end long before the pendulum gets there?
This is absolutely not a head fake. This is very different than what we saw in 2008. Now, 2008 was a financial crisis driven by too much liquidity. That liquidity sloshed into commodity markets and drove prices higher overall, particularly the China-focused commodities. This is a molecule crisis. We're out of many different commodities, aluminum, the gas. This decision just now, the Nord Stream in Europe, is critical. It's a lack of supply. We like to call it the revenge of the old economy. Put bluntly, returns in the old economy were terrible. Capital was redirected to the new economy, choking off the capital that was needed to grow the supply base, and we're left with the problems we're seeing today. You multiply really strong demand on top of that, we draw our inventories, and you now are really out of many different commodities. Gas, coal, oil, we still have something in inventory, but if we keep at the deficits that we're doing right now, by early next year, we're going to be exhausting inventories there as well.
What can we do right now, and what are the chances that we do it domestically, Jeff?
Well, let's talk about the two options that the administration has put forth. By the way, neither are going to do anything to solve this problem. OPEC doesn't have enough to solve this problem, particularly if we don't see Iran return. But let's go over the options that they put forth. The first one is the Strategic Petroleum Reserves, of the SPR. The second one is the crude oil export ban. So let's start with the SPR. Right now they could do about 60 million barrels. More likely, they're probably going to do something around 30. They really have made a big commitment to do this. But because, as you just pointed out, the IEA thinks you're going to be in a surplus at the end of next year, because the DOE themselves believe prices are declining, that means they'll probably do a swap format where they lend the barrels today and then they buy them back sometime next year. The other thing that's on the table, by the way, that's probably worth $2 to $3 on the price. The other one on the table is the crude oil export ban. This is bad policy. Why? Because if you ban the exports, you're going to take a lot of oil off the international markets. And remember, gasoline prices off international prices. This would create a spike in Brent prices. Yeah, WTI would get crushed and probably go to $40 a barrel, but Brent would be over 100. And gasoline prices off Brent. So, if you instill the crude oil export ban, yeah, it's going to crush crude oil prices domestically, but gasoline prices are going to soar. There's 11 senators who signed on to the crude oil export ban. It's not a good solution here. We think the one they'll likely do would be the SPR, 30 million barrels. That's just a drop in the bucket. That doesn't solve anything. I think, keep your eyes out on those two options.